Thank you, everybody, for coming today. We're excited to have such wonderful guests, and I think we're going to be able to learn a lot today. My name is Ryan Arnold. I'm a senior here at Trinity University, and I work at the Office of Investments, and I'm a finance major with a entrepreneurship minor.
Hi everyone, my name is Ellie. I am a junior and I'm majoring in human resources and then minoring in entrepreneurship.
And then our lovely guests, they have microphones to be able to introduce themselves.
My name is Juanita Sepulveda. I'm an entrepreneur, a veteran, and I'm here locally.
And I'm Sebastian Garzon, and I'm the Executive Director of Alamo Angels, a group of angel investors here in San Antonio.
And my name is Craig Crow. I'm the Chief Investment Officer here at Trinity University.
All right, great. So me and Ellie both have questions that we're going to be asking them today. I guess I can start off with the first question, and then Ellie can take it for the next one. It's going to be open style, so we'll ask a question. Y'all can answer if you have an answer. Then if you don't have anything to say, then no worries. Somebody else can take the answer. Okay, first question. What is the process that should be considered to accurately value an early stage company when they are opening a fundraising round and they tell you that the capital they are raising is based on their determined valuation?
Good start. Good start. Let me start by thanking you guys. I know it's a smaller crowd, but hopefully this will make our discussion even more meaningful. So if Craig and Juanita agree with this, we would love to hear from you guys as well, so that we can definitely answer your questions as well as the ones that we have prepared here in the panel. I think that will hopefully will be the key to success out of today's discussion. And with that, Ryan, it's valuation. I think it's such a subjective topic, particularly on the early stages, right? Because when we're looking at early stage companies, this is not one of those things like a bank that is asking or looking at quantitative data. A lot of times when we look at these early stage companies, it's more qualitative. For us in Alamo Angels, we get together every single month, feature at least 3 companies, typically invest on at least one of them, investments of $50,000 to $300,000, and most people will think, okay, you're investing on the product, you're investing on their IP. What is it that you're investing on? And at the end of the day, and in reality, we're investing on the team. Obviously, the market is important, whatever traction they've done, but because it's so early, the question for us is, do we have conviction that this is the team that can take that business idea or that company to the next level? And if the answer is yes, then we probably go after that. And so it's a lot more qualitative than it is quantitative. That's one thing that I always like to highlight. And then in terms of the valuation itself, while I'm saying that it's subjective, I think it's important to look into benchmarks, right? So if I get a company that is super early and they tell me we are worth $20 million, if it truly is a pre-seed or a seed stage of development, it's probably going to be out of scope as compared to other companies within the same stage of development. So I think benchmarking is going to be super important.
I think that was really well said. So similar but different to Alamo Angels, we don't typically invest directly onto cap tables of businesses. So we will invest in a fund that will then do that on our behalf, and that can be across Silicon Valley. We invest in different ecosystems around the U.S. and abroad, including L.A., New York, and Austin, as well as some internationally. And I think the only thing that I would add to round out to Juan's really very well said point around subjectivity, team, idea, momentum, traction, other things, is there typically seems to be almost a reverse equation around how much dilution you want to take, what is the capital plan for the business, and stage gating, whether you're in the seed, Series A, Series B, there's a series of benchmarking and milestones that we see in our portfolio that typically command higher premiums, lower premiums. Once you start getting traction, what's your growth rate? how quick are the adoption curves, how quick are your sales curves, what does the cash flow profile look like, other things. So that all matters. But in reality, when you're so early, valuation, if you do it well, whether it's a $15 million pre-money valuation or 12 or 16, it typically doesn't matter if it's a successful investment because the dilution metrics are really what matters.
I think first of all, I would agree. I would echo all those. However, I would actually add risk assessments. So I'm very studious. I actually wrote all your answers down. One of the biggest things for us when we look at things is risk assessments, right? Identifying the assets, the potential of the market, doing the analysis for it, even though they come in to be able to look on the, to request funding or whatever it is that they're wanting, developing that relationships for me is one of those things that you're really going to be partnering with them to be able to do those assessments, do the market value, as you're going into determining what the value of what they're going to be in return. The other thing, too, is as you're getting ready to do some of the investments and you're starting in the earlier stages, what are some of the benefits you're going to have? Are you going to have voting rights? Are you going to have certain terms that are going to be set up? So for me, being able to understand the value of what I'm going to be determining at the forefront of it, the biggest things for me is the risk assessment. Most small businesses do not do business analysis, right? They get all excited and they start a business, but they haven't learned, the parameters of where their business is. And then the other thing too is as you're getting ready to do some of the businesses, especially with the small one or whatever mid-size or large, the other thing too is have they determined how they're defined, as they're getting ready to move and become established businesses. Because there's different definitions according to the SBA, and I'm sure you've probably already learned that as you're going through when you're starting to identify, then as you're getting ready to address to either an angel donor or pursue additional fundings.
Thank you.
So my question is a little bit similar to Ryan's. This one's a little bit geared more towards pitching. So for entrepreneurs who may be new to the fundraising process, what advice would you give them for effectively pitching their ideas to potential investors and showcasing the value of their ventures?
I just don't want to take over. I started on the previous one, Juanita. Do you want to give it a try first, or you?
I'm so sorry. I'm such a nerd. I
And
literally write
how did
everything
you
down.
have the questions? And did you get the questions, Craig?
You didn't read your emails?
Or do you know?
There's the
people that
risk
we don't?
assessment I was talking about. So pitches. What was the question again? Oh, here it is. I got it. I'm such a nerd. I really did stay up all night answering these questions. So one of the things for the students, right, when you're getting ready to do a pitch, be focused and be very clear about your message, right? You have to be able to make that connection with your audience. That's first and foremost. And I'm going to kind of refer to some of the other things that I've done. I usually know within the first 30 seconds or 60 seconds on whether or not I'm going to do business with someone. And that sounds kind of bad because I really do believe in synergy. If I'm able to understand their concept from the beginning and I'm able to connect and I'm able to relate to it, I'm now being able to take a look at as they are showcasing their capabilities and what they're really investing in. Now I can see the value in it. But really, honestly, the first thing is being able to focus on the clear value and articulate what the venture is really about. If someone was to ask you, what is your idea, and you stutter, then have you really done your research on it? You have to be able to, every question, because you're the subject matter expert in it.
I will say yes, and I will just highlight the fact that when you are pitching an investor, these investors are not going to open up their checkbook right away after you pitched. So I think what you need to keep in mind is the fact that you are pitching them, but your goal is not to get a check right after that pitch. Your goal is to generate enough excitement that that one investor will want to continue that conversation, right? And so just we all talk, or we all have heard about the whole concept of the elevator pitch. That's what that is, right? You need to have the main points that you can share, that people are going to remember what it is that you're doing, that people will understand, right, Juanita? Because we do get a lot of founders that, they've got great ideas, but they are just not able to articulate those ideas. And so that's going to be important, but most importantly, that they are going to be excited enough to want to give you an additional meeting. Like practical examples for Alamo Angels, we invite those companies, they come, they only have 8 minutes for pitch, they have 10 minutes for Q&A. And so it's 18 minutes total that they'll have on stage to pitch their company to these investors. And that is not when those investors are making that decision. The next step is what we call a deep dive. And so the week after, we get together for a 1-hour session with the executives of that startup and those that heard the pitch and want to continue the conversation. Then that's the next step. And now it's a 1-hour long discussion where we continue to ask perhaps a little bit more meaningful questions, dig deeper into what's going on with the company. Then from there, you do due diligence, and you will continue to ask more questions. And then assuming that everything checks the marks, then you'll get a check. So it is a process, but as it relates to the pitch, I will say the key element to it all, if you come out of this session with something, and if you truly are wanting to raise funding or pitch your company or your idea, is do not come with the expectation that you'll get a check right away. Do it in such a way that you are articulating the message and that you are generating excitement.
I think what I would add is that throughout this process described, it's about progress milestones too. It's talking about, getting the feedback of here's what I think you need to do, steps that you need to take to either further product development, go get more clients or users or customers, do this. It could be other metrics. But taking that feedback and actually following up around that, I think, is really important and a very underrated part of this whole process. I think people get super caught up in the original pitch, but it's, to me, I think where we've seen some of the biggest success stories, as well as, the funnel part of it, right? You're going to talk to 100 people, you're going to get 15 meetings. Those 15 meetings are going to turn into 7 pitches, and 7 pitches are going to turn into 3 follow-ups. It's really that, as you curate that, that fact pattern as you're going through that process around following up and the traction that you're continuing to get. Because things are so logarithmic and exponential so early in the life cycle of these businesses that, it could be, hey, I've got 40 users this week, I've doubled to 80 this next week. Okay, wow, that's an impressive metric, impressive progress, and just continuing to follow up around that, I think, is really important, those progress milestones.
Yeah, I guess my question goes right into that. My next question, at least. So what are these key performance indicators or points of traction that you look for within a early stage company?
Maybe I'll try this first. So ARR is probably the most quoted metric, right? Annual recurring revenue. So it's typically in software businesses or businesses where you sign annual recurring contracts. It could be product development. So the actual product, what does that look like? What progress has that made, whether it's an app or some software widget? It could be team development. So, hey, I'm not a coder or an engineer, but I've got this great idea. I've actually got 2 or 3 people working on this now, so I think it's seeing traction around that. And then customers, getting feedback, iterating around the product. How many people do you have this week versus next week versus the following? What are retention rates within that customer base, and how does that look like? So I'll stop there, but I think those are probably 3 or 4 key elements.
I think it depends on the industry and the stage of development. So let's just take one as an example. So technology. For us, it'll be particularly because we're not investing when it's an idea or concept stage. We're investing, if you guys are familiar with the whole stages of development, you typically have the pre-seed where idea, concept, typically is your friends and family, and I'll add fools, the three Fs, friends, family, and fools are the ones that are writing you a check. And the reason for which we say that is because you have nothing to show other than you as a person, right? And so that's the first stage. Then we have the seed stage of development, and I think that's where I like to answer the question, because that's also where we play a part. At that stage, is no longer idea, is no longer a concept. You actually do have something to show, but this is not something where you have millions in annual recurring revenue. You just have some modest growth or some modest KPIs that you can share. And so let's take a technology company. At that point, you probably have a team in place that's going to be super important. And I don't know if that's a metric. I guess you could come up with a metric in terms of number of people, but for that one is more making sure that you do have people that are complementing each other and providing the resources that the company needs in order to grow, right? So somebody that does finance, somebody that does marketing, and some very early on, one person could be doing multiple things, but we do like to see that team type of approach, so that we know that there is multiple people, primarily when there is like a technical founder that will benefit from complementing his or her skills with somebody that can do business development, as an example. So having a team, also a team that is working full time, it's important for us, because at that stage, if you truly are serious about this as a company, we want to make sure that this is not just your side job or like a hobby. Once you are getting other people's money, you want to make sure that you are, you're showing that you are fully committed in making this happen. So that's one. An MVP, right? A minimum viable product. If you guys used Facebook or Instagram when they first came out, is significantly different from what we've got today, right? But it did iterate, and it continues to iterate to the point where we have it now. But that's not how it started. It started with something that was just functional, and people started using it, right? And so that having that MVP is important, because that allows you to also have early customer feedback. Marcos was kind of pitching us at the reception area on his idea. And that's one of the things that you have highlighted, right? We've came up with these, and we already have users. Those users are not even paying anything, but you do have a numeric number in terms of people that are using this platform, but most importantly, can give you feedback so that you can continue to iterate, so that you then feel comfortable of charging someone that will actually pay you something for what you're developing. And so that's important. And then I think the monthly recurring revenue, or the annual recurring revenue, is going to be great. Is not a must in some cases. Let's take another example: a medical device company, or anything within the life sciences. Those are whole different sets of metrics, right? At that point, we're looking at, did they have FDA clearance? Do they have a reimbursement code? And it's a whole different thing. But just to keep it simple, I'll say those would be some of the things that we'll be looking into.
I think he was reading my notes. That's pretty much, the other thing too was, he talked about the active users. Is the product actually being able to be utilized? Showing those milestones, so as they continue to invest into you. And I was looking at, and I think I was sharing with Greg earlier, it's taken us 6 years to bring our product to market. And we've come to a halt because now we're having to do all the legalities of it, right, so that we can contain our product. And whoever your investor is looking at is, once you start, your business, have you developed the infrastructure of your business correctly? Because if you haven't, you're basically just wasting the money that your investors has given into. You've got a great plan, you've got a great business plan, you've got a great product, but if you didn't start off correctly and you didn't share that with your investor, or you didn't, pursue support so that you can continue to achieve those milestones to show that your product's going to come to market, you're already backtracking. So the lifetime value of for the customer as well as the investors is another thing that I would consider.
And And depending on stage, we haven't talked about TAM, which I'm sure everybody's familiar with, but total addressable market, it's probably one of the most fungible metrics that you can have. But I think showing and trying to quantify some sort of market size and what you're attacking is, and how that aligns with the value proposition will probably be a key part of any early metric tracking it. Venture investors tend to want to invest in something behind something with large addressable markets that can attack, a big space.
Okay, so the next question I have is, how do trends in economic conditions and market dynamics influence your approach to early stage investing, and what advice would you give student entrepreneurs to navigate these fluctuations effectively?
This is probably one that maybe we would have a good perspective on, because Trinity's endowment invests alongside a bunch of premier partners in the all across, whether it's public equity, private equity, venture, real assets, other things. And so depending on what is going on from an economic standpoint, we shift those allocations. So we might lean more towards liquid investments at some points in the cycles, illiquid investments, and maybe investments that have narrower dispersions of outcome, private equity, or wider dispersions of outcome. So venture tends to be probably the widest dispersion of outcomes in terms of, as we think about the metadata. So saying that another way, the best performing managers versus the bottom performing managers probably have the widest spread of value to any asset class we invest with. So public equity, that top quartile to bottom quartile spread is pretty narrow. People are, if you think about U.S. large cap stocks as a public equity strategy, the best performer versus the worst performer in that, it's a pretty narrow band, whereas venture capital is the widest band. And so economic inputs go into those allocation decisions as we think about it. We try to be long-term in nature. We try to be contrarian in how we think about it, as an example, but it can be pro-cyclical. As an example, it's a really tough fundraising environment right now, right? You saw exuberance in especially early, late-stage venture capital over, call it, post-COVID, 2020, 2021, and you saw some washout in 2022 once you saw interest rates started rising, and so you see large investors shift their allocations over time based on those dynamics. So maybe I'll stop there.
I think the other thing too is the priorities of the investors too also change. Like you said, post-COVID, a lot of the several companies were starting to look at more self-sustaining. As a matter of fact, we were having this conversation earlier that most companies had brick and mortars, right? We didn't. Ours is all virtual. So we didn't have any overhead. That's the other thing too, is when you're taking a look at the shift in the trends in the business area, what is it that's going to bring you your best value? And even though, and I'm going to tell you right now, for me, I didn't go through a business degree. And we were talking about, the book E-Myth, right? Learning the terminology as you're going through it. I went through a fire, hydrant pouring into me as we were going, trying to discover everything that we were doing. But the one thing that I loved about what we were doing is, as we were building our business, I saw so many other small businesses start paying attention to what they were going to affect, right? And granted, as you're going through your classes and you're trying to understand the trends and really what you're going to bring the value to the market of what your product is, maybe the terminology isn't always what you're understanding in the presentation of the definition. But the other thing too is when you're looking at your product and you're going to bring it to market, does it fit? Does it bring value? Right? Even even in the worst of times, post-COVID right now. The other thing, too, that we were discussing earlier was, was it Kira? Kiera, right? And then Antonia, right? You were talking about the product that you were bringing, why it was. Is it going to improve your environment? I wasn't looking at improving my environment. I was looking at learning on how to help my fellow man, especially during post-COVID. And the terminology, these gentlemen are so well versed in it, but my business partner, who actually worked for the EMY, was the one that said, no, you have the capabilities. You just didn't have the definitions of it. So the trends that I was looking at is I was looking at the stock market. I was looking at what was the need in the community, in the environment. So that's how I was looking at trends on what I was going to be investing in. Not just the stock market, but in actual commodities, structural inventions, innovation, technology, even water filtration. Maybe that's not what you were asking, but the trends that I was looking at is how is it going to improve my local business, my local environment. Those were the trends that I was looking at as I was getting ready to invest into small businesses that were here to stimulate the economy here.
I'll tackle this one from an industry perspective, and I'll ask you guys a question. What is the latest trend? Talking about trends, what's hot right now? Marcos? AI, right? So everyone is an AI company now. I cannot tell you how many companies that come to us that are like, yeah, we're the latest AI and buy now. What was the previous trend? Another big one before AI. No takers? Crypto. Everyone, like everything is crypto. Everyone wants to get on that one. But when you go and look at the history of these trends, at the end of the day, you'll quickly realize that it's really not the trend itself, it's the fundamentals within the company. So with that, I think the message will be do not let these trends and this coolness of things get to you in terms of saying I'm building the latest AI company just because everyone is talking about AI. Yes, I think AI is a means to the end goal, but it's not necessarily where you should base off your pitch. Because that happened with crypto. Everyone was all of the sudden doing crypto, and then now all of the sudden every single company it's AI. And while you are implementing and utilizing some of these tools, just make sure that you are not necessarily starting your pitch with the fact that you are the latest AI company. It's more we are a company that is doing XYZ based off AI tools that can help us accomplish this, right? So that would be my comment on that one.
Awesome, yeah. Once again, leads me right into my next question. So if you're looking to invest into a venture capital fund or just a early stage company, what are the steps taken in your due diligence? And what are some of the early stage industries that might be appealing for VC now and in the short-term future?
Should you answer that? Ryan works for us. He's our intern.
I was actually hearing that, and I think that right now some of the things that I've seen, because I also do a lot of stuff for a VC firm, and some of the really popular stuff right now is name, image, and likeness as like a industry trend, and I don't think it'll last very long. But every company in sports says they do something for NIL, and there's only X amount of college football teams, but there's just as many NIL, either collectives or companies that want to boost it. And I think eventually that's going to fall apart, or there's going to be some kind of legality taken against it. One way or the other, I don't think that would be a good investment, but everybody that I've seen through the VC firm is trying to pitch in some way or another NIL. So hearing that, understanding the team, that makes a lot of sense. And then I also think that CPG is something that's always strong. It's a strong industry. People are going to pay their couple dollars for their Monster Energy drink. They're going to pay their couple dollars for whatever it may be because it's cheaper in CPG rather than going out and investing in a tech firm that doesn't have the software built out yet, but they can promise you the world for the future of what they can build when they get that developer or they get that software engineer. So I think CPG in the future is going to be good, and I think that NIL in the future probably won't be. But I'd love to hear y'all's answers on that.
So for me, one of the things that I'm looking at is organic farming. I just had bees put on my property because of, pollination. I don't know if you heard in the news how sometimes the discouragement of creating your own gardens. Have anybody been to Fruitopia, the organic farmer that's here in town? So have you heard of, what's it called, desert areas where food is lacking, right? And what really kind of stunned me into moving into that direction is I had an investment, a philanthropy group that I was part of, and it really bothered me because they were telling the story about a child that he picked 2 crackers versus an apple. And it really disturbed me because they thought, well, why wouldn't you pick the apple? But this was a child that picked the 2 packs of crackers. Can anybody answer why? Yes, ma'am? Absolutely. Preservation. Because he had one to eat that morning and one to eat for dinner. And who was to know that he didn't have a little sister at home? So this child was being ridiculed because he didn't pick the apple. So moving forward is horticulture for me. Horticulture infiltration. The contamination of water is very scarce right now. If you see the Edwards Aquifer, like I'll attend a lot of those meetings, those are the things that I'm looking at, the natural resources, because once they're gone, they're gone. No one's going to be able to produce land. There's no more land to produce. So the other thing, too, is that I was looking at is indoor farming. Some of those stilts that you do the rotations, you can bring a product to market in 28 days versus 34. Now, that doesn't seem like a whole lot, but if you're talking about an industry such as strawberries, when you can get them year-round because it's being cultivated through solar or ultraviolet lights, right? Those are the areas that I'm looking at. Preservation.
I'm gonna try to give you nuggets as hopefully practical things that you guys can take home when this session is done. And with that, another one will be. It almost sounds like if Juanita had a fund and she was investing in companies, her investment thesis will be on preservation, right? And I think the message that I like for you guys to have, and it's important, I'm gonna tie it to a comment that Craig had said before, is Craig had said, it's a funnel game. A lot of people are going to tell you no. And I'm also telling you there is investment thesis, right? And so the message here is know that depending on who you are speaking with, they're going to have an investment thesis. And so if you are a software company that is pitching Juanita's VC firm and her investment thesis is on preservation, you are not going to get funded by it, okay? Because you are just not a good fit. And you, first and foremost, you should do your homework and identify who these people are that you're talking with, so that it's a good use of your time and their time. There may be some times where there's a gray area where you're like, okay, I may be a good fit for this, and you do submit an application and they determine that you are not. So that takes me to the final game. Just know that you do have to knock in a lot of doors prior to them opening them up for you and for you to actually be able to come in and do something meaningful with them. So do not get discouraged if you are talking to people and they are telling you no, because out of 10 people you speak with, there may be only one that will actually have an interest on what you're doing. And so that doesn't mean that you are a bad founder or that you have a bad idea. It's just that you got to keep going and until you identify the person or the firm that can provide you with the guidance and then the funding, obviously, that can take you to where you want to be at. So that'll be my nugget.
Tell me the question again.
If you are looking to invest into a venture capital fund, what are the steps taken in due diligence? And what are some early stage industries that might be appealing for VC now or in the short-term future?
Okay. So for us, going back to tying in to a similar thread here. You know, some of it can be chicken and egg, where the way we think about entry into a lot of these VC firms, typically track record is a really important metric that we look at. So have they done this before, and have they had success doing it before? And that can be a real challenge, right, if you're raising money for your first company or doing some other things, because a lot of those groups might have an associated metric with previous track record. Maybe they only back repeat entrepreneurs or other things. So I think curating that funnel is a really important aspect that I want to double click on, because you know, you think about the matrix across, you know, seed all the way to late stage, or thesis, whether it's software, life sciences, CPG, maybe energy transition, or some of these other areas. I think aligning your focus and aligning your efforts and doing some research on the front end with that approach will be really important. But I mean, I think as we think about it, you know, track record is a really important element in understanding that track record. So, you know, how many of these businesses have you invested in within your investment thesis? Have you sold any of these businesses? What do those return metrics look like? You know, has the team been consistent throughout? It sounds kind of boring and monocratic maybe, but it's an important element for us as we think about building relationships with folks.
The next question I had was, what are some common pitfalls or mistakes that student entrepreneurs often encounter during the initial stages of launching their ventures, and what strategies would you recommend to mitigate these challenges?
Let's see. You specifically say the student entrepreneurs. So I will say the team element of it all is super important. And sometimes when you are still going to school, when you're so young, I know because I used to be that person that thought that I can do it all. And the older you get and the more experience you get, particularly in business, you realize that you are better off doing it as a team as opposed to doing it on your own. There is nothing wrong with a solo founder, but a lot of big accelerators, very well-known accelerators like YC as an example, they do not invest on solo founders. They invest on companies that have multiple founders. And the reason for that is kind of what I've said before, is they want to make sure that they are complementing each other. If you do not want to go that route, at least surround yourself with people that can provide you with guidance and support so that you can get to the finish line. But I have seen most of the successful companies, they do have more people as part of the team that can help them get to where they want to be at. So I think surrounding yourself with people that can help you. But most importantly, if you are a finance major, try not to get with another finance major, because they will most likely have the same type of skill sets that you have. I would rather get somebody that can complement what you are trying to do. And universities actually do a really good job at this. I'm not as familiar with what's happening with Trinity, but there is case scenarios where there is like engineering students that get paired up with business students, and then they start businesses. And the programs that these universities are putting forward are doing this by design, because they know that complementing those skill sets can take these potential companies to another level. So surround yourself with the right people, and do not be afraid of sharing this journey with somebody else that you believe can complement your skill set and help you get to where you want to be at. I'll pass it on to you guys and see what else you'll get.
I don't know that I would have anything in the context of adding to mistakes made, but I would just encourage perseverance through this process. That's maybe more of a general virtue just across the landscape, but I think it probably really is applicable in early stage investing, early stage business formation, startup, and and just would encourage you all through that journey there, because it you know, we see it in some of our portfolio companies, right? This is a long game that people are playing, and we've seen traction hit at different points in the cycle for businesses, and that's been probably one of the most fascinating observations we've had. Is, you know, the term pivot, you've probably heard, right? Or you know, you re-engineer something. It's been interesting to see some of those iterations within our portfolio companies, and all of a sudden you know, they're 6 years in, they've pivoted a couple of times, and now they're hitting some escape velocity just around some of these different metrics that we've talked about. And every situation, there's facts and circumstances associated with it, but I would probably just leave you with that perseverance and encouragement there.
So when you start your business, right, and even if you have a business partner, my mentor told me there's only one architect, the visionary. You may have a partner, but if it's your idea, you're the one that's going to be feeding into it. You're the one that's going to be creating it. A team is going to, you know, move it forward, but you're the visionary. You're going to be constructing it. You're going to be, you know, feeding it. You're going to be able to make the changes to it, because only you know what the end product was going to look like. And when we started creating ours, right, I could see already 5 different stages. My business partner couldn't see that. So I was the visionary for our idea. He did the structural, he did the processing and things of that nature. But being able to diversify a company, right, not just finish your product, but be able to do the full research of it, right? I recommended a book, and it sounds funny to a lot of people, but it's called the E-Myth, right? And it tells the different stages that an entrepreneur goes through, right? You're the technician, you're the manager, and you're the owner. And as you become an entrepreneur, you're going to go through all these changes, because just like Greg said, you know, sometimes you're going to have different parts, you know, within the company, but have enough confidence to know when it's time to source it out. Because that's the growth that the VCs are looking for, right? You've created the idea, you've been able to execute it. How are you going to grow it? But there's always going to be just one visionary, one architect of your business. And if you're the one who created it, you're the one that's going to take it to the end, even though it's the team that's going to support you along the way. Some of the other mistakes is you underestimate the costs. You know, you don't have a good budget with it. And then the other thing, too, is you don't have the confidence to ask for help. A successful entrepreneur will ask for help. You'll find those mentors and fire them if they don't have their best intent, especially for your business. Those are some of the mistakes that I made, and it took us 6 years to bring to production.
We might have forgot the most important metric, especially over the last few years, is burn rate, right? Know your burn. How much are you spending? What are you spending it on? Because a business typically dies when they run out of cash. So you don't want to do that.
Explain burn rate to everybody.
Yeah, burn rate is you know, your essentially what's your profit in terms of or if there's not, how much cash you have on the balance sheet versus what you're spending on a monthly, quarterly, or annually basis. So it's basically your time till I run out of cash. Because a lot of times, you know, your contribution margin or, you know, your individual metrics of profitability are strong, but you're investing in growth, you're investing in your business, you're hiring more people, you're buying more product, doing more product development or R&D, and so you've got to know where that cash is going and how quickly it's going out the door.
Just want to make sure the burn rate makes sense with the amount they're asking for, especially with the time till profitability, correct?
Yeah, that's right. I mean, it's typically a big, you know, it's part of the pitch deck of, hey, we need $500,000 to, 250 are going to go into product development. We're going to go hire a team. What else we're doing, but also how long that will last you, because that can vary quite a bit. So,
Cool. Okay, my last question.
or are we time, or should we go to Q&A? Are we still on time? Okay.
Okay, yeah, my last question. If you could tell college students one thing about investing into early stage companies or getting funding for their early stage ventures, what would it be?
I would say this is very relationship driven. Just establish those relationships early on and truly look at it as a relationship versus a transaction. When you are if you truly are building a startup, you should know that this is something that's going to take years for you to execute on. And again, all things considered, and depending on the circumstances, it could be anywhere between 5 and 10 or 15 years, right? Like, it's going to be a longer time. And so if you do get an investor, just know that you're going to be with them for a long time. This is not just one of those things that they'll invest on you today and they can pull back their investment next week or next month or even next year, right? Like, for us as investors, we're there in the long term and we want to make sure that you succeed. But we have no interest in getting our money back until there is some sort of exit that will provide us with a multiple return. Otherwise, we will be acting as banks if we wanted to get a percentage return, right? So just know that it's a long-term game. And just like everything else in life, you choose your friends based on your values and how you, or your lifestyle, or, based on how you want your life to go with, and surround yourself with those people that share those same things. Same goes with your partner. And the same way should be for your investors. Because they're, depending again on the stage of development or why not early on, a lot of times they will provide advice, but they don't necessarily have a vote as it relates to where should you take your company towards. But as the company matures, they will then have a seat on the board, as an example, and then they'll have a little bit more control. And as you continue to raise funding, then more people, more external people, these investors, obviously the bigger investors, are the ones that are going to be asking for them to have a seat on the table because they want to have some sort of control. And so with that, you want to make sure that you are aligning yourself with the right people that can provide value, but also know that it's a relationship and it's not just a transaction.
If you could tell college students one thing about investing into early stage companies or getting funding for their early stage ventures, what would it be?
If you're going to invest into an early stage company, what does it mean to you? Because just like you said, you're not expecting the money back. Is it something that you really believe in it? You have to be completely, invested in it without expecting anything back. I'm going to have to echo, just like, I'm sorry, how do you pronounce your name? Sebastian. So sorry. I have to echo what Sebastian says. If you can't relate to that small business that you're investing in, and you're only chasing the money, you're not doing them any justice. And if you're only asking them, asking for an investment just to be able to get it launched, but knowing that you're not going to bring it to fruition, then don't start something that you can't actually bring to fruition.
I think mine would just be a growth mindset. I think when I talk to students in class, or I typically speak to the SMF program every year. I always talk about this, but and I think it relates to startups and getting funding. But just you kind of go through this linear path, right? As you go through your school career and your education, you're always you're progressing, right? Second grade to third grade, fourth grade to fifth grade, et cetera. And I think that dynamic, when you get out of school, is quite different. I've taken, as I think about my career path, as you would think about your, startup, I think the analogies align. It's not necessarily a linear path, and I think it changes, values evolve, relationships, different forms of capital, human capital. You learn more, and I think that growth mindset and those elements of curiosity, I think, are probably a higher corollary of success than pure IQ or other things. And so just would encourage that, from my own personal experiences as you launch your business and pivot and get feedback and evolve, and the market evolves with you. All of these elements are changing. It's a multivariate calculation, and just would encourage that.
Were you gonna say something too?
How many of you know that there's like prodigy programs here in the city of San Antonio? Yes. So there's an Alamo supported prodigy program. There's also mentorship programs through Geekdom. If you haven't developed a concept, they have programs that you're able to develop the concept. Then you also have like through the protege program, one of the things that they do is that they take you to courses that's related to an idea that you want to develop. So as a student, you're learning it. But if you're already an established business, they partner you up with an established business that went through the prodigy program, because it's a pay it forward. So in preparing you to be able to do contracting, whether it's an 8A, local, or federal, right? So because there's different levels of being able to do business, right? The other thing too is a lot of your local businesses actually qualify for some of the grants that the city has. There's also grants and things near historical areas that most people are not familiar with. We're part of the UNESCO. Are you familiar with that? The UNESCO? We're only 2 cities in the state of Texas qualify under the UNESCO, and that's because of our missions. That's one of them. The other thing too is for, I think it's like food, I think it's right. I think we're recognized for food and beverages and things. Do y'all know Johnny Hernandez? Where he does the cooking for the homeless, right? So they actually do programs like that also for the restaurants areas. And then the other thing too is there's technology and patenting and copywriting programs here also in the city of San Antonio that aid you in understanding that as well. Just didn't know if y'all knew that.
So here's a big one that I would really like for you all to leave this room with. There is a difference in between a small business and a startup. And I think it's extremely important for you to understand where you fit within that spectrum as you get started on this journey of entrepreneurship. Because it's 2 whole different ball games, and you are going to be dealing with different things depending on which one you fit your idea or your business on which bucket you're going to be at. A small business is more on the traditional sense of things, right? Yeah, a restaurant, a construction company, businesses that may be more local in nature that don't necessarily have that scalability potential, nor do they want to have it. Johnny Hernandez, he's got multiple restaurants, but he's not creating the next Chili's of the world or the next Fridays of the world. He's doing just fine with the few restaurants and the catering company he's got, and that's what he wants, and that's okay. That is a small business. If we get Johnny Hernandez saying, I want to create the next franchise out there, and it's now going to be True Flavors chain, right? Then that is a different story, because now his business plan is looking to expand True Flavors all throughout the nation. And so 2 whole different things, one of which is traditional in nature, the other which has the scalability potential built into it. You need to understand where you fit, because it's going to change all dynamics. Juanita mentioned grants. If you are doing a tech company, it's going to be hard for you to get a grant. I think it's going to fit more on the traditional. Again, it all depends. That's the answer to most questions. But generally speaking, it's going to be difficult for you to get a grant. You can get and that's the other thing. As an example, investors. That not everyone needs an investor. And when people come to me, I'll tell them, I just met with someone today, and I told this founder, great, you are bootstrapping, keep doing it while you can, because when you get a third person in the room or in your cap table, right, when somebody else comes into the mix, you now have a little bit more pressure because it's no longer you or your family or your friends. You got a third person that is expecting, for you to perform. And it's also the most expensive way of raising capital, right? So you are now giving them a part or a portion of your company, and so it's just a whole different thing. So make sure that you double click on what it is that I am, what it is that I want. Am I a small business or am I a startup? And then go from there.
Okay, great. Now we're gonna go into our short Q&A. So if anyone has any questions, you can go ahead and ask them.
Good question. Um, Fundamentally, the investments that we're doing are way different from the investments that someone like Craig is doing. Uh, and there is a couple of things that I will highlight. The first one, you know that there is quarterly reports that these public companies are issuing, right? By law, you do have to provide those. That is not the case when you are investing on the private market. It is considered best practice, but it's not a requirement, okay? Particularly in the very early stages. If you do invest on a company that is a private company, but they are a little bit more mature, you can get clauses that will include information rights, as an example, where then you stipulate, I need to get a report every so often. But generally speaking, when we talk about early stage companies, it's really considered more of a best practice than it is an actual requirement. And so with that, that's why we always come back to the team. One thing that we do at Alamo Angels, we actually ask for you to provide us with your latest two investor updates. The reason for which we're doing it is we want to know how do you communicate with your investors, because we believe that based on that trend, then we can expect that same level of communication with us once we join your cap table. And so it's a way for us to mitigate the potential risk of giving you money and then you not disappearing, but maybe just kind of like going and doing whatever you want, but not necessarily providing us with the information that will keep us informed as of how our investment is doing. That's one. And then the other, and I'm not sure if this is what you are referring to or not, but how do we keep track, not necessarily of the use of funds, but how do we keep track of how we are doing as in our portfolio? Easy for you, you got a lot of metrics. For us, at the end of the day, how do you guys know how an investor, VC or an angel investor typically makes money? On an exit, there you go, right? And so you typically go and ring the bell in New York and you say, you know what, I'm doing an IPO, I just went public, and so investors will then get their money back. The one that happens the most is typically through mergers and acquisitions, right? So a bigger fish comes and acquires your company, or you merge with another larger company, right? Or unfortunately, this is also part of an exit, which is you go bankrupt and you just kind of write it off, that one investment. But how do it's not until 5 or 10 years down the road that you truly realize what your return was, because you had to wait until that happened. So how do you keep track of your portfolio? Is through some of that progress that Craig kind of mentioned earlier. And you can keep track of that because every time you go back and raise a new set or a new round of funding, then your valuation typically will change. And assuming that things are going the way they're supposed to, then you go from one stage to another and your valuation should continue to go up. And so we then can make a quick calculation as of how many shares do we own and how much do they represent based on the latest valuation from that company. At the end of the day, and in all honesty, it's almost a fictional number because those numbers don't really pay off until the company goes through an exit.
Any other questions?
Marcos, raise your hand. You were just pitching us earlier today. There you go.
How many of you are preparing to be entrepreneurs? Are y'all from here? International. My daughter's doing international, so she's much further ahead than I am. She laughs at me all the time. But then she comes back and asks me for money.
Take advantage of us being here. I think that we are, it's uncommon sometimes to get a panel of people like, I mean, not to say that we're like important people, but we, our schedules get busy, and I want to make sure that you guys do take advantage of that and know that there is no such a thing as a silly question, right? So if you do have any question, just send it our way. We'll be happy to answer it. Marcos. I love that because there is a lot of people that get hung up in the fact that they don't necessarily have a KPI, and you do, right? So you could have taken a different approach, which is, oh my God, I don't have anything to show because there's nobody that is paying for this, and that's one of the traps that a lot of people fall into, especially when they are doing it for the first time. For you, while they are not paying, you don't have any revenues. You do have a number in terms of users. I don't recall if you said it was an app or not, but the number of downloads could be another one, right? They may or may not be using it, but that's one of them. You know, if you're just now getting something started, as an example, so I'm gonna get away from your example, answering your question, which is, are these good KPIs? I think they are, and I will definitely encourage you to keep track of those KPIs. You're on the right track. But let's say that you are coming up with an idea and you don't know how to go about coming up with those numbers. One will be a very efficient and very simple way is just getting a landing page where you will ask someone if they are willing to, or if they have an interest on learning about that one product, right? Or maybe even what the Cybertruck did, right? Like a lot of people actually had reserved the Cybertruck, and I think they were paying like $100 or so, right? Or something like that. Not everyone ended up purchasing it, but they then had a metric out of the people that said, if you do come up with that ugly truck, I'm just kidding. If you do come up with that truck, then we will purchase it from you. You know what I mean? So those are metrics that you can come up with, and it's fairly simple to get them. It's just a matter of think about what can I do in order to start showcasing that there's people that are willing to pay for this.
I'm so sorry. Also, if you have a product that's similar to another, doing a comparative analysis, right? And what I mean is like a stroller, right? For we took a product on just a very simple stroller that could travel either to Colombia or to Spain or to Mexico, because when you're getting ready to do business outside the country, you have to take other things into consideration too, right? In the development of it. So one of the things that I had a student do, because they wanted to do exportation on a simple stroller, is I had them do real-time comparisons. So they just went to Target and was in the children's aisle, in the stroller aisles for like other products like the swings, the strollers, and things of that nature. And they were asking the parents that were walking up. And I know that's very simplified, not at that much of a level, but they were looking at exportations. They were looking at being able to scale it. But if they didn't know what the consumer was looking at, you may not even start your business. You may not even start exportation. And then, did you know there's a certification you can actually get for exportation? Yeah, the federal government does it. It's also a gold, I think it's called a gold level package that you're able to go through. And they'll actually take you to those countries to be able to do business with other countries.
So for context for the group, Marcus has it's a workout app that encourages gamification as part of participating in that. So my only feedback, in addition to what you're already tracking, I think you're on the right track, but is there a way to track outcomes as far as like how much, cardiovascular improvement they've had, or, basically the engagement, turning engagement into some fact pattern of outcomes? Yeah. Yeah, so I think time series data will be important as you think about, not only your value proposition, but as you go continue to scale your business.
Okay, I'm gonna wrap it up here. Oh, never mind. Sorry.
Might have been about actually, yeah, start of the pandemic, maybe 3 years or so. I came across a report, which I don't recall the source, but it said that most companies pivot 4 times on average before they get to where they end up being at. And so, regardless of the number, I think the message here is pivoting is something that will most likely happen. I don't know how many times, but it could happen. But I think this will help me validate the fact of the importance of having a good team in place. I think that's part of the reason for which we truly look into the jockey and not the horse, right? Are these the right people to, when the market conditions change, are they the ones that can pivot and make sure that, me as an investor, I'm not going to lose my money. We may be affected by a few months, but they can take it and pivot it quickly and take it to where we want it to be at. So pivoting is definitely something that happens. It happens more often than most people think. At the end of the day, it's not necessarily how many times or whether it happens or not. It's more, are you the person that can adapt to the new market conditions and that can take this to where it needs to be?
Now I'm gonna wrap it up. I wanted to thank Juanita, Sebastian, and Greg for taking time out of their day today to come and speak with us, and for everyone for attending. And we're gonna have the refreshments outside, so you can continue networking outside for a little bit. Thank you.